Dzień dobry, witam Państwa bardzo serdecznie. Michał Duniec, analizy.pl. Jesteśmy w siedzibie Franklin Templeton w Polsce. Mamy możliwość, jedną chyba naprawdę z pierwszych, porozmawiać z osobą, która zajmuje się inwestowaniem w zgodzie z ESG i współzarządza funduszem ciemnozielonym. Będziemy pytać o to, jak ten portfel jest konstruowany, będziemy rozmawiać o tym, od kiedy Craig zarządza funduszem. Moim i Państwa gościem Craigiem Cameronem, zarządzający portfelem, a także analityk poszukujący spółek w funduszu Templeton Global Climate Change. Craig, I'm happy that you are today in Warsaw, happy that you decided to share your thoughts and experience about investing in ESG. You are with Franklin Templeton Group for more than 10 years, and I would like to ask you how, in your opinion, what's the crucial difference between dark green and light green ESG fund, because this is not that common to split the differences, and moreover it's important which companies you include in dark green and you're not include in dark green fund.
Yeah, so I think the way that we think about the impact strategy that we manage is really that a dark green product is generally one that is trying to achieve a sustainable investment objective. This is a fund that is set up to have some sort of a positive environmental impact, and that's actually part of the stock selection that certainly for our strategy that we are using. That's not the only approach, obviously, that you can take to run a more dark green fund, but ultimately it's about whether the fund is trying to have a positive impact, or whether the fund is just considering factors that are relevant for environmental and perhaps social factors as well. So in my perception, or in my view, the difference is often what is the fund trying to achieve. If you're a light green fund, often it's trying to sort of tilt the portfolio in a certain way, whereas with a dark green product, you're often seeking out a specific type of company that you want to invest in because it has certain, often positive environmental or social characteristics.
Okay, and when Templeton decided to label the fund dark green, because the history of fund is more than 20 years, and that wasn't that those names, light, dark green, just came a couple years ago, and when you decided to label that dark, and what changed in the process to keep it dark?
Absolutely. So in 2018, we decided to take an existing product and convert it into the Global Climate Change Fund. From the outset, we wanted to create an impact product, a fund that was able to invest in companies that were truly benefiting and driving change in the environment overall. It's been that way for the last 5 years, and since then we've seen a number of categorizations arise and different labels that the fund has come under. One of those would be the Article 9 SFDR label. Mm-hmm. And there, I think, that helps to define what we're trying to do with the product. We have a sustainable investment objective. But in many ways, the fund has not changed in those 5 years. We've always been doing that same thing. And I think that's in my view, certainly
the exclusions are all the time the same since
the exclusions
changing
have
the
grown
strategy?
over time.
Yeah, okay.
But the core exclusions that we started with originally have not changed, and the type of company we're looking for has certainly not changed. What we're looking for is companies that are having a positive impact on the environment through their products and through their services, and that focus on what is a company selling, as opposed to what is the company doing with its own business. Is it cutting emissions? Does it have good environmental policies? That primary focus for us is what is this company providing? Mm-hmm. Providing products in the solar industry or the wind industry, the electric vehicle industry, companies that are truly what I would call forward-facing and sort of providing the new technologies that we need to get to a low-carbon economy, as opposed to the old economy.
Okay.
That's where we're focused.
So how you are able to identify those companies? So please explain us how the whole process is built, how many people are involved to find the right companies, and I think one of the most important things is how you cover, so many companies all over the world and select just 50 of them. Yeah. Please be so kind to give us some details.
So we have a global equity team that I'm part of, the Templeton Global Equity team. We have around 35 analysts and portfolio managers globally, and all of them are involved in selecting companies. The core team that I'm part of that then manage this product is 5 of those. We have 3 portfolio managers and we're supported by 1 analyst and 1 associate. That team is responsible for then building on these ideas and taking ideas perhaps from other analysts around the group, doing that extra work on the climate change impact, the way that a company impacts the environment, and ultimately helping us to build that portfolio. I think that the most important thing is that our analysts are looking for attractively valued companies globally, and so that's a really great kind of starting point to build on and to select the best companies from. But as it pertains to stock selection, our initial screens, we use a screening process where we are looking at companies on a range of metrics. We consider, we have 2 types of companies in the portfolio. We have the solutions companies and transitioning companies. Mm-hmm. And we score every company in the index on solutions and transitioning. We're looking for companies that are some of the best performers on these metrics, and that really helps us to get a good lead into potential stock ideas.
So you said you got two types of companies, but you also said that you are paying attention for valuation. So let's switch a little bit from ESG and go to the valuation part. Of course, ESG is one of the most important things and that you consider, but when I was looking for metrics, I recognized that the fund is cheap. I mean, as well as P ratio, price book value ratio are comparing to the indexes are low. How it is possible to build a portfolio of ESG? I imagine that it's hard to find ESG company with low valuation, and you are able to do this. How are you gonna to select those companies?
Sure. So I think I mentioned we're part of the Templeton Global Equity team. That group has been investing with a value investment philosophy now for almost 70 years, and so using that database of ideas that our team are selecting, we naturally lean towards more attractive valuations. I think within the space or within the climate change thematic, we do try to look for the better valuation opportunities, and we want to stay nimble with our portfolio. That's not to say we only buy companies that are below a certain multiple, but if a company gets cheaper, we want to own more of it, and if a company gets more expensive, all else equal, we're happy to bring the position down. I think the main difference that we have with our portfolio, perhaps relative to the index, is some of the sector weightings. We really like the materials sector in the economy, which tends to be a lower multiple.
Can you give us some examples of companies that are?
Absolutely. So there's 3 categories within the materials area that we mainly invest in. The first is the metals or the mining companies that are providing the resources that we need for the low carbon transition. Think of lithium, copper, aluminium. The second is the companies that are processing these resources and turning them into the materials that we would use in for example, electric vehicle battery. And the third group of companies are packaging. So you can think of the cardboard packaging or aluminium sort of recyclable packaging that we can use that is replacing plastic in consumer
Can you give us an example of those companies, the names, or you're not allowed?
Yeah. As far as I'm aware, I can. And so the companies I would use, I mean, we own shares in Smurfit Kappa, which is an Irish-based cardboard box manufacturer. I think it's a great business and a very attractive multiple today. In the the battery materials sector, I would give you the example of LG Chem. LG Chemical, which is one of the world's leaders, not just in producing electric vehicle batteries, but also in processing those materials beforehand. And then in the metals and mining sector, I would use the company Albemarle, which is a North American business involved in the extraction and processing of lithium. that ultimately ends up in electric vehicles. So these are all businesses, I think. One of the key things that we're looking for is, do we need a lot more of this company's product in a net zero world, or do we need a lot less? We need a lot more electric vehicle batteries, and therefore we need a lot more lithium. We also need to be using a lot more sustainable packaging as opposed to plastic packaging. And so, in each of these examples, these companies, I think, have a lot of growth ahead as a result of the low carbon transition. But the valuations of all of these businesses, I think, are quite attractive on a price to earnings multiple today.
Okay, so the selection strategy is bottom up?
Absolutely. Wherever a company is based, we're happy we own it, and we don't try to manage to the benchmark weight. Okay,
so why, as a result of this bottom-up approach, you achieved overweight in Europe? How is that possible?
Yeah.
What's behind that?
So I think there's a few reasons. So first of all, from a valuation perspective, European companies are today trading at a reasonable discount to companies certainly in North America. The second is, and I think we sometimes don't always appreciate this, Europe is home to so many climate leaders. Whether it is the world-leading cabling company, Prysmian from Italy, whether it's
Is that your choice? I mean, Prysmian, your recommendation, your personal?
It's one of our top 10 holdings in the fund.
Top 5, I think.
Possibly top 5. Whether it's Saint-Gobain, which is the world leader in what I would call sustainable building materials, based in France, the world leader in wind turbines, Vestas in Denmark, or the world leader in LED lighting.
I mean, Vestas is like popular in Poland, maybe not for everyone, but if you are traveling, you can see a lot of Vestas all around producing power, and this is the name that probably would be recognized by Polish investors. Okay, so the explanation why Europe is so present is because the valuation, because of the...
Yeah, these companies are global leaders in the products they provide. They happen to be headquartered in Europe, but actually, I mean, in the case of many of these companies, they have a lot of North American and Asia sales as well.
Okay, when I was thinking, what's interesting in the ESG fund, pure dark green ESG fund, is how to measure that. I mean, how to prove to investors, not only by delivering the report, but also by delivering the metrics, which metrics you present to provide, the proof that, okay, this fund is dark green and we are improving every year.
So we show the first thing, I mean, there's really two metrics that we think are very important for every company in the portfolio. The first is the percentage of what we call green revenues. That's revenues related to climate change mitigation and adaptation. We track that for every business in the portfolio, and at the portfolio level, we have a requirement that 50% of the revenues across the portfolio have to be in climate change mitigation and adaptation. And we detail that on an individual report for every single company in the portfolio. The second is what we call avoided emissions. Theoretically, if I think about, we mentioned the wind turbines that Vestas produce. If you build a wind turbine on its own, it's a lot of cement, there's steel, carbon fiber, it's construction work. Kind of in isolation, just thinking about that, there's emissions associated with it. It's not a very renewable product, at least not today. The real benefit on installing a wind turbine is that it is replacing something else. The more wind turbines we build, the less coal we need to burn for power. The more sustainable, the better our air quality, the more lower carbon our grid becomes. And so the value in the wind turbine is actually that it's replacing the traditional fossil fuel generation. And we want to measure that benefit. To give you another example, if I install a solar panel in India, which is a very high carbon electricity market, I'm creating a much larger benefit than, say, if I install a solar panel in France, which is a very low carbon electricity market. So we want to give credit to those companies that are making big steps and big improvements to cut emissions through their products and through their services. And we measure that at the individual stock level, but we also show it at the overall portfolio level. And what I'm proud to say is that, per our quarterly impact report, for every 1 ton of CO2 that our companies are responsible for at the scope 1, 2, and 3 emissions level, they are avoiding somewhere around 12 tons of CO2 through their products and services. And that's the kind of positive impact that we want to see from our companies.
Okay, but in my imagination, at the great end, there is some limit that you are not able to cross, or there is no limits. I mean, the world will improve all the time, so you will be lower and lower with the metrics. How it's...
So, I think theoretically we could continue to grow that number, but of course it would push you into very certain types of companies, and that would not create a very well diversified and sensible portfolio. So I think we try and improve that metric as much as we can, but also within the constraints of building a well diversified and sensible portfolio for our clients. The number has improved over time, and in particular as we're getting more data. Companies that perhaps didn't or were unable to show their positive impact in the past are now starting to do so, and that's one thing we also encourage our businesses to report on and to explain to their investors. Often the biggest environmental impact that a company is having is the product that it sells, rather than its proportion of renewable energy that it's using in its own manufacturing or its own facilities. And so, I think in that environment and in that example, we want those companies to shout about it and to tell investors, here is the impact we're having. And so, as we get more data, that number also naturally improves. And I hope that's something that will become more standardized over time, because I think it's a great way to measure the impact of a company, rather than focusing always on scope 1, 2, and 3 emissions.
So mainly you explain us when and why you buy, but when you sell company, what's the portfolio turnover?
Sure. So portfolio turnover has generally been about 30%. I think over the last 12 months we're about 33% or so. That's probably higher than we would normally. So it's not a buy and hold position? Not always. I think a lot of that turnover is driven by position size adjustments. So certainly we've had a very volatile, say 12 or 18 months more recently. And so we have been active in moving around our position sizes, even if the names have not changed very often underneath. If a company is becoming more attractive, I think we always want to own more of that company. And if a company is doing well, we're quite happy to sell that position down. The kind of, I guess, ideal turnover, I would imagine, is more to the 25% or lower. So we would generally expect to hold our companies for about 5 years. Okay. And the reason that we would sell, primarily is valuation. Even if a company is having a fantastically positive impact on the environment, if the valuation of the company is not attractive, I don't think we should be investing our clients' money in that business. And similarly, if the environmental impact is low or irrelevant, it doesn't matter what the valuation is. We should not be putting our clients' money in that.
You are focusing on the environmental part of ESG. What about S and what about G? I mean, we talked about dark green fund and we spent 15 minutes about E. Do you have any exclusions covering G, S? How does it work?
So most of our exclusions today are associated with environmental factors. We do have other social related exclusions, such as tobacco or alcohol, and I think often those are companies you would not expect to see in our fund anyway. In fact, the Templeton Global Equity Group actually has a long history of what we would call socially responsible investing. So, many of our funds going back 40, 50 years plus would not invest in certain products because of the social implications, and tobacco is a good example of that. But I think overall, the key thing about our product is we have what I would say is a higher minimum standard on all of E, S, and G. So on our own internal ratings, we have certain cutoffs that we will use, and if a company does not meet a standard, we won't invest. And we also do more detailed analysis on social and governance factors before we put a stock into our portfolio. Even if it's recommended by the analyst and is owned elsewhere, we still want to meet the requirements of the Article 9 regulations that we adhere to. Are you able to invest in nuclear plants? Nuclear is an exclusion for us. Is that a norm for dark green? In general, it tends to be an exclusion across most of the space. It's certainly the area of most debate, and I think nuclear, in your opinion, is correct that it's excluded? I think it makes sense. I mean, nuclear is not a renewable fuel. Ultimately, if we were to start to build a lot more nuclear, we would very quickly start to run out of uranium supply. And I think there's also geopolitical questions about today. A lot of the supply of uranium comes from Russia as well. I think nuclear is low carbon. We can't, that is definitely a positive relative to things like coal and gas that we burn for power. I would say I'm certainly in favor of companies keeping nuclear open as long as possible to help us with the low carbon transition. But ultimately we need to be building a lot more solar, wind and hydro today as opposed to nuclear. There's also the aspect of the time it takes to develop these projects. We are likely to pass the 1.5 degrees warming that we are trying to avoid in the Paris Climate Agreement by about 2027 or 2028. There is almost no nuclear facility that has been built in less than 4 or 5 years. So if we want to avoid the 1.5 degrees warming scenario, nuclear is not something that's going to help us. It takes in general 10, often 12 years plus. What we can build in 5 years is solar, wind and hydro.
Excellent. Is this fund popular worldwide? Where from, actually?
Sure. So we're seeing a lot of interest in primarily in Europe. I would say really in all regions across Europe, we're seeing interest. I think being able to demonstrate both the performance aspect, but also the environmental impact has been a real crucial thing for investors. And often there's a perception that you need to trade one for the other. So being able to show with our fund that actually we have delivered both has been a real benefit and has generated a lot of interest.
Okay, so thank you very much for this conversation. The most important thing that I notice is it's not only ESG, but it's deeply fundamental driven fund, Article 9. I'm happy that you spent time with me. Mine and your guest was Craigiem Cameronem, the portfolio manager of Templeton Global Climate Change Fund. Thank you.
Thank you.